guys, it's Gabby G here. Gabby G in NYC with another episode, and this one is really focused on my first-time home buyers. Well, all home buyers. But it also is going to be able to help other people who are looking to get a loan. Today we are going to be tackling the topic of debt to income ratio, or DTI. Okay, so first and foremost, DTI, or debt to income ratio, your debt to income ratio, it really compares how much you owe to how much you earn. And lenders look for this all the time. They consider it in every opportunity when anyone approaches them for a loan. This is something that goes into consideration. It's a major factor as far as you acquiring that loan. So what it is, according to New York Times and Wells Fargo, this is like information that I've gathered from all of those places. It's the percentage of your gross monthly income, okay, that goes towards payments for rent, mortgage, credit cards, or any other kind of debt. Okay, so a good way of remembering gross versus net is gross is like a lot of like, oh, he ate a gross amount of donuts, like just huge. Okay, so that's the entire thing pre-tax. That's your income. Your gross income is the entire thing before taxes and stuff is taken out. When you think of net, that's what you actually catch. That's what you capture and throw over your back like a little fisherman. Okay, so you think of net is what you're actually taking home in your little net. Okay, that is the difference between gross and net. It's just a good way to remember the difference between the two. But anyway, so this DTI, it's a comparison with your gross monthly income and your debt monthly, usually. It's just the easier way to calculate it. And I'm going to tell you how you're going to calculate that number, and then basically the number that banks and lenders are looking for. So the first thing you're going to do is add up your monthly bills. So this is rent, mortgage, anything you pay monthly that's loan or some sort of debt, alimony, child support, student loans, auto loans, any other kind of monthly loan, as well as credit cards. Big debt issue in America. We know that, right? So credit cards, but you're going to calculate your minimum payment, not like the balance of the card. It's your monthly. This is the monthly thing. So use your minimum payment. And any other debt that's similar to that in terms of loans are just something that you're going to be paying for a while, not necessarily forever. And usually things like groceries, utility bills, and gas, for your car, and taxes, things like that aren't usually calculated in that monthly expense. So just keep that in mind. It's really the loans and things like that. Okay, so that's not usually included. Then what you're going to do after you get that number, your monthly debt number, then you're going to divide that by your total gross income. Okay, so just everything pre-tax, your total gross income. So you take the first number, divide it by the second number, and that's going to give you a decimal. You then, as we learned when we were little kitties, in order to turn that into a percentage, you're just going to swoop over that decimal 2 spots to the right. Okay, and that'll give you your percentage, which is your DTI. Okay, now the lower your DTI, the less risky you are to banks and lenders. So we're going to give you a little example with numbers so that you understand completely where I'm coming from. So say you owe $2,000 in debt. Your monthly debt is $2,000, right? And you bring in a gross amount of $6,000 in terms of income. So you're going to take 2,000 divided by 6,000. You're going to get a number that goes 0.333333. 0.33. You're going to just swoop those numbers over, and that becomes 33%. Okay, that is Good. We like that. Okay, banks and lenders typically like to see that your debt, your DTI is like 43% or less. The lower, the better, you know? So 33 would be nice. Very nice. We like that. So you've got good DTI. You're in good standing in terms of that. And it gives you a better idea of what you can afford as well. Then let's give you an example of the other side of the spectrum. Now, say your debt is like $4,000 a month and you still only make that $6,000 in gross income. So you're going to take that $4,000, you're going to divide it by $6,000, and you're going to get a number that's like 0.666666666, right? You're going to take the decimal number, the decimal point, swoop it over to, and that's 66% DTI. Way more than what they hope for in 43% or lower. So that's no bueno, because keep in mind, this is not factoring in your groceries, your gas, your utility bills, your, getting your hair done, nails done, all those other things that you do on a monthly basis, going to the barber, going whatever it may be. It's not even factoring that in. And it's not factoring in your taxes either. All of this stuff is gross amounts. So if you're at 66% on your gross amounts, so you're gonna have to use that remainder of money after taxes taken out and all of that. The remainder of your money is going towards everything else you need, which is groceries, your bills, your other bills, right? And so you don't have money to take on anything else. So that is usually what will go into that will be a factor for banks when they're deciding whether or not to give you a loan. So we want to make sure that we keep our DTI as low as possible, okay? The lower your DTI, the better, okay? We don't want to be risky to these lenders because we want to be able to have some sort of great buying power. And this all factors into your credit score and your this and that. It all matters. So I hope that you understand debt to income ratio just a little bit better, and you tune in to check out my next video. Thank you so much for watching. Love you guys. Bye.